there is a quick reminder, a discussion forum on the e-class. Anyone who has questions, drop it there. The teaching assistant is always waiting and looking to see if anyone has questions there that we can discuss. With that being said, also, if you look on your e-class, Taslima posted an update that the Cactus book that we are using for financial accounting, they've actually included some more supporting information and resources that you can use in order to get more practice for the financial accounting aspect of this course. So feel free to explore those new resources that's available to you on Cactus. Today, we're going to be looking at chapter 1 and 2, and then at the end, again, I'm going to go into another quick midterm discussion just to tie up any loose ends that anyone would have. I'm also willing to stay after class a little bit later, just in case anybody has other questions that maybe they were practicing something and they need some help with that. Now, I'm going to do things a little bit differently. I'm going to skip chapter 1. Not forever, I'm going to come back to it, but I realize that when we get to the end of the class, people start getting burnt out and tired. So chapter 2 is where I'm going to start today's lecture, because chapter 2, I believe, has those concepts and those things that are not, they're kind of abstract, not very easy for you to understand. So I want to start with this when we're all fresh and not too tired, so that we can get as much of this content and knowledge retained as possible. All right. So in this chapter, we talk about managerial cost concepts and cost behavior. And the first thing that we need to realize is that we need to have an understanding of exactly what cost is. What is cost? Right? In order for us to manage costs, this is the managerial costing side of the course. In order for us to manage our costs, we need to understand what cost is. All right, so a simple definition: cost is a financial measure of the resources used or given up to achieve something. All right, another term that's also important is a cost object. And a cost object is anything that we can assign a cost to. So I found this really a really cool video. I think it's kind of funny, but it also has a lot of the cost concepts, the concepts that are going to be talked about in this lecture, explained in more of a humorous way.
Welcome to another episode of Managerial Accounting. I'm your host, Michael McLaughlin, PhD, CPA, and the only person to have successfully trained a ferret to ride a bicycle. Now, before we discuss activity-based costing, the balanced scorecard, and other ideas that will change your freaking life, we need to cover some basic cost concepts. Let's start by asking the most fundamental question: what is a cost? You're probably thinking, look, I know what a cost is. It's when a company pays money to acquire inventory, or it's when a company pays wages to its employees, or it's when the marketing team spends $900 on kale for the company picnic. Who's going to eat all this kale? It's got lots of vitamins. Why won't anyone eat this garbage? It's technically edible. Now, those are all clearly costs, but I'd like you to think of costs more broadly. A cost is any resource sacrificed or foregone to achieve a particular objective. Thus, costs aren't just about making money. Right now, you're watching this video, but you could be knitting a sweater, reading a book, or becoming a level 70 wizard on World of Warcraft. You're giving up leisure time, or time that could have been spent working, in order to learn something, so you are incurring a cost. By choosing one alternative, you're giving up another alternative, and that's called an opportunity cost. Thus, not all costs involve the payment of money. Sometimes you're paying out money, but other times you're giving up another resource like time. Now, I know what you're thinking. Who knew accounting could be this exciting? I know how you feel. I felt the same way when I learned that groundhogs could predict the weather. Now that you know what a cost is, let's define the term cost object. A cost object is anything for which you can assign a cost. A cost object could be a department, a division, a product, even a customer. You can measure the cost of pretty much anything, which led one student to ask me, what is an example of something that is not a cost object? That one had me stumped until it hit me. Love. You cannot put a price on love, unless you're in Las Vegas, in which case anything goes. Now that you know what cost objects are, prepare to have your mind blown. Cost can be either direct or indirect. Wow. What is a direct cost?
All right, so he says costs can be either direct or indirect. What do you think direct costs are? What do you think the difference between a direct and an indirect cost is? Direct costs are part of the finished product, like materials, okay? And an indirect cost? Go ahead, Oshini.
Sorry, this is just a guess, but like indirect costs, like would they be costs that are incurred in order to like function the business, but like not directly, like paying employees, for example?
Okay, okay, I see. Very interesting. So I'm not going to tell you the answer. I just want you to think about what you suggested, all of you, what you think the direct costs and indirect costs are at this very moment, and then he will clarify it for you, and then I will do some even more clarification when this video is over.
I'm glad you asked. A direct cost is a cost that is directly traceable to the cost object. Conversely, an indirect cost is a cost that is not directly traceable to the cost object. So, direct costs, traceable; indirect costs, not traceable. Here's an example. If we're manufacturing tandem bicycles, the cost of the tires used on the bicycle would be a direct cost of making the bicycle. Whatever the tires cost, let's say $100, was a direct cost of making that bicycle. We could say this $100 went into the tires that are put on that bicycle. But what about the rent you pay for a factory to manufacture the bicycles? If you pay $50,000 of rent for the factory, we can't directly trace that $50,000 to any specific bicycle. Thus, factory rent would be an indirect cost of the product, which in this case is a pathetic product, only purchased by someone who is desperate for attention or too lazy to pedal their own bicycle and wants to free ride off someone else's effort.
All right, so let me jump in there. So we talked about direct and indirect costs, and he said a very important word there, traceable. A direct cost is traceable to the product. And in this example, there was a bicycle, and the cost of the tires as a direct material, you need to have those tires in order to produce that bicycle, right? That's directly traceable. It's easy for us to say, okay, the tires cost $100, and that's how much we're going to trace towards that one bicycle for that raw material, the tires. But the indirect cost, it's not easily traceable. So we cannot trace an indirect cost and say, this is how much of this cost is going into producing that bicycle. Okay, and the example he gave was the factory rent. Now, before somebody said, these are costs that we need, direct costs are costs that we need to create the finished product. So yes, we do need the direct costs to create the finished product, but do you think we need the factory rent? Do we need the factory in order to produce that product as well? Yes, so we also need the factory. So the factory rent is indirect, and it's still very important in order for us to produce the product, right? So the difference between the two, it's not that one is more important or less important for the finished product. The difference is one is traceable, easily traceable, and one is not, right? So for example, we're building tables. So we have to build tables, and one of the things that we need to build a table will be the direct material of lumber. So the lumber, the cost of the lumber, it'll be very easy for us to say, you need 2 pieces of lumber in order to produce that table. 1 piece of lumber costs $5. So you need 2 pieces to produce 1 table. So the the lumber costs $10 in order to produce one table. So we can easily trace that $10 of lumber to one table. But if we have a factory and we're producing 100 tables per day, and you have the factory rent there, right? Is it easy for us to say how much of that factory rent goes into the production of the one table? Is it easy for us to figure that out? No, it's not easy at all. It's very, very difficult. So that's the difference between the two. One is traceable, easy for us to say this is how much it costs to produce that. The other one is it's not traceable, not easily traceable. And that's the difference. All right.
So all companies have direct and indirect costs. But with manufacturers, we can make another distinction. We have product and period costs. For a manufacturer, all costs incurred to manufacture the product are called product costs. This is important because product costs are not expensed immediately. They attach to the product and are only expensed when the product is sold. Because product costs become attached to the product, they are also known as inventoriable costs. This concept is actually quite profound because it means that a manufacturer would actually capitalize the labor costs of factory workers. If a factory worker is owed $700 after a week of work, the company would not record wages expense. Instead, it would increase the inventory account. The labor cost would be expensed later when the product is sold. I told you that was profound. If you feel like your head is about to explode, it probably is, although it could also be those drugs you took this morning. Now, there are three types of product costs: direct materials, direct labor, and manufacturing overhead. Manufacturing overhead is the most confusing of those three costs for students to understand. It includes all manufacturing costs other than direct materials and direct labor. Factory rent, insurance for the factory, the salary of a production manager or a janitor that works in the factory, those are all examples of manufacturing overhead. These costs are necessary to manufacture the product, but they cannot be directly traced to the product. Thus, you could think of manufacturing overhead as indirect manufacturing costs. So now that you know what a product cost is, you're probably wondering, what is a period cost? And I'm not going to tell you unless you purchase my managerial accounting course for the low price of $500. I'm just kidding. I don't have a paid course. The only paid course I have teaches you how to become a millionaire overnight by gambling on iguana races. A period cost is simply any cost that is not a product cost. When you manufacture bicycles, you incur marketing costs, advertising costs, and administrative costs like the salaries of accountants or the CEO. These are all examples of period costs. Period costs are expensed when they're incurred. Unlike product costs, they do not attach to the product and become part of inventory. Before we end today's lesson, I need to talk about a type of cost so vile, so repugnant, so insidious that I hesitate to mention its very name: the sunk cost. A sunk cost is a cost that has already been incurred and cannot be recovered. Let's say your friend Pete obtained a master's degree in puppet arts from the University of Connecticut. And yes, that is a real degree. A link will appear in the description section below. But before you master the arts of puppetry, remember that such a degree will make you functionally unemployable, may cause your family to disown you, and will mean the end of your social life. But let's say that your friend Pete ignored these warnings and spent $40,000 to get the degree. Shortly after graduating, Pete bumps into Elon Musk at an airport and is offered a job at Tesla. But then Pete tells you, I can't take the job designing cars at Tesla. Otherwise, the $40,000 I spent on a puppetry degree would have been a waste of money. This is an example of a sunk cost. Pete already spent the money on tuition and he can't get it back. He needs to focus on making the best decision going forward and ignore what happened with the tuition. Many bad business decisions have been made because executives failed to ignore sunk costs. Sunk costs should be irrelevant to decision making. This has been a lot of information for you to take in, so let me summarize today's lesson. If you ride a tandem bicycle, please stop. You're a serious road hazard to squirrels and small children. That's all for today.
Okay, so from that video, we saw a discussion of a bunch of different types of costs. And so we learned about direct costs, we learned about indirect costs, we heard direct material costs, we heard direct labor costs, and we also heard manufacturing overhead and And those three things are what come together to create a product cost. So if you think about this logically, if you think about this logically, if we were to create a table, right? We need to produce a table. We need to have direct materials. We need the materials in order to be able to create that table, to produce a table. And we also need labor. We need people who are able to work the machines and whatever needs to be done in order to convert those raw materials into a table. And then we need the manufacturing overhead. And we learned that the manufacturing overhead are very necessary. We need these things in order to produce the table as well. The only thing is that these manufacturing costs are indirect costs and therefore cannot be easily traced to the product. Okay, so direct materials plus direct labor plus manufacturing overhead. The direct materials and direct labor are obviously direct costs, easily traced. It's very easy for us to say, Bob worked on creating that table. He spent 5 hours. Bob's rate is he gets paid $5 an hour. So we know that the direct labor cost to produce that table is $25. Okay? So easy for us to figure out those costs. Manufacturing overhead costs, really difficult for us to figure it out, but it's possible. We don't trace it. What we do is something called allocate it. We allocate those costs. Don't worry about that for today. That will come in a later lecture. Okay, so we have here the big picture where we have product costs, and we learned that there's a direct cost and the indirect costs. Okay, direct materials and direct labor are the direct costs, and then manufacturing overhead is the indirect costs. These three costs here make up the product cost or the manufacturing costs. Somebody in the chat asked, is manufacturing overhead the only indirect cost? No, it's not the only indirect cost. Period costs are also indirect costs. And now, period costs, another way of thinking of those are the non-manufacturing costs. These costs, we don't need these in order to produce the bike. We don't need these costs in order to produce the tables. Why we need these costs, we need them in order to sell, okay? These costs have to do with selling costs as well as administrative costs. Any questions on this table? All right, let's keep going. You're gonna get a chance to see these concepts one more time because I'm gonna talk about them one last time. So product costs, it can also be known as an inventorable cost, can also be called manufacturing costs. Product costs, inventorable costs, manufacturing costs. If you see these terms, they mean the same thing. Now, as I said before, direct materials plus direct labor plus manufacturing overhead, MOH stands for manufacturing overhead, is equal to product costs. The V here means variable manufacturing overhead, and the F here means fixed manufacturing overhead. Point is, those two things come together to make a total manufacturing overhead. Once we add those up, we can come up with the cost of producing our product. So in your mind, think of a product that you would like to produce. Can somebody give me an idea of what we should produce? Give me an idea of a product you want to produce. Cake. All right. So let's assume we're producing a cake. We have to produce a cake. Now we have the direct materials or flour or eggs, water, oil, vanilla essence, all that stuff goes into our direct materials. And the direct labor will be the baker and the decorator of the cake. And then the manufacturing overhead costs are going to be, for example, the kitchen that you are producing the cake in, you will have to pay some form of rent for that kitchen, okay? Or maybe you will have someone who works in the kitchen, but doesn't necessarily touch the cakes, right? But they are working in the kitchen. They don't actually touch the cake, or they're not directly involved with the baking or decorating of the cake, but they're very essential in terms of the production of the cake in the end. That person's salary could be a manufacturing overhead cost. Electricity as well, very good, thank you. The electricity, the utilities that are used in that kitchen will also count as overhead cost. Okay, so we said product costs are costs that are absolutely necessary for producing the product. We need these product costs in order for us to be able to produce the cake, right? So they are direct costs, and these direct costs are easily traced to the product. But then the manufacturing overhead is an indirect cost, and we know that that cost is not easily traced, all right? How much does it cost to build a Tesla car? This is the example I have here. So direct materials, we have to consider that. If we want to build a Tesla car, we're going to have to think about which materials do we need to produce this car. And then we have to think about the direct labor, the labor cost of all of the employees that are working together in order to change or convert the steel and the paint and whatever else is used in the production of the Tesla car into a finished good. So these, the wages of these employees, technicians, welders, mechanics, these wages are going to become part of our direct labor costs. So now we talk about the manufacturing overhead, and I reiterate again, these are the indirect costs of producing our product. So they cannot be directly traced to a specific unit. All right, so for example, we can say we made 100 Tesla cars in the month of January, and somebody said utility bill. The utility bill for the factory was $10,000. Now we know what the total cost is for that month of producing those 100 cars, but we will not be able to find out a unit cost. How much of that $10,000 of utility bill is going to be traced to producing one car? That's the part that gets really confusing, okay? So if it cannot be easily traced, then it's going to be considered manufacturing overhead costs. As long as you need it in order to produce the product, but it's not easily traced, it's going to be manufacturing overhead. And overhead is equal to indirect materials, indirect labor, depreciation in the factory, factory rent, factory utility costs, maintenance on factory machines. What's the word that I keep repeating over and over and over again when I talk about overhead? Just now, indirect materials plus indirect labor plus depreciation in the factory. What's that word that keeps repeating? Factory, exactly. So any indirect costs, that are incurred inside of the factory are going to be called manufacturing overhead, okay? If you think about one of the managers in the warehouse, one of those managers, do you think the managers actually go and start pounding nails and cutting steel and all that stuff in order to produce the Tesla? Does the manager do that? No, the manager does not do that, right? But you still need the manager in order to organize the people, the labor inside of the factory, right? If we didn't have him to draw up the schedules for work and whatever else it is that he does, directs all of the work that's happening in the factory, then we would not be able to have a finished product, especially up to the standards that we have set. So that manager is essential to the production of the Tesla, but he does not actually touch the product. So his salary is not direct labor, okay? his salary will be counted as manufacturing overhead. Does that make sense?
Hey there, students. So in this video today, I'm going to go over direct versus indirect costs. That's what we're going to be talking about. It's important that you understand these terms. Now, this first chapter, or first and second chapter, are mainly about terms, because I need to lay the foundation for you for the rest of this class. You have to understand how these terms work. And don't worry, we're going to practice a lot of test questions with this in a little bit. First, I want to introduce you to a few things. So, direct costs. What is that? Well, direct costs can easily be traced to a product. Let me show you. So here's a cool example. We're going to use a car. So what are some direct costs that you can easily trace to a car? What can you recognize there? Let's think about it. So an engine. That's easy, right? You open the car's hood, there's an engine. That's a direct material, is what they call that. And we'll go over that in a little bit. But that is easily traced or directly traced to that car. Now, what else can be easily traced? Well, we have assembly time, right? So some dudes are working in a factory and they're assembling that car. So that can be easily traced to that car. You're like, well, that guy right there worked on this car, right? Easy. I just traced him, that cost, to the car. Or that steering wheel, it goes in that car. You can easily trace it. So that's called a direct cost. You can directly trace it. Now, let's talk about something else here. What are indirect costs? So we talked about direct, but what's an indirect cost? Well, these costs have to be allocated to that product. So imagine the car again. It's not as easy to trace as like a steering wheel or an engine or assembly time. These are more difficult costs, so they don't call it tracing. They call it allocation. You allocate it to the car. Now we have like power tools, right? Because you have a power tool, but you work on a lot of different cars with that tool. So it's really tough to directly trace a tool to that car. Now what else? Electricity, right? You have electricity that powers that entire automobile plant. Can you really trace each little piece of electricity to each car? Not really. That'd be really tough to do. So you have to allocate it. Now don't worry about actually the method of allocation right now. I'll show you that later on. But all you need to know right now is that there are certain costs that you can trace to the car and certain costs that you have to allocate. So let me go back one more time here. So again, indirect costs are allocated. Direct costs are traced. That's what you have to know from this. Write that down. All right, that's about it for this video. Very short video.
So are we comfortable with the idea of direct materials, direct labor, and manufacturing overhead? What the difference between direct and indirect costs are? Direct and indirect manufacturing costs? Good. Okay, so this list is just a list of different indirect labor costs. So an indirect labor cost will be a manufacturing overhead cost. The janitors in the factory building, supervisors in the factory building, material storeroom personnel, cost accountant salary if the cost accountant works in the factory. Indirect materials, including oil and nails. Sometimes indirect materials consist of materials that the cost of it is so small that it's not worth it for us to go ahead and trace the costs. So we just include it in manufacturing overhead. Other overhead costs include utilities for factory buildings. Somebody mentioned that. The depreciation on factory buildings and equipment, the payroll taxes and fringe benefits for the manufacturing employees, repairs and maintenance on factory buildings and equipment. So anything that occurs inside of the factory is part of the product cost. But some of it is easily traceable, like the direct materials and the direct labor, and the rest of it is not easily traceable, and we call those the manufacturing overhead costs. Now, the period expenses, as I said before, are all selling and administrative costs. Selling and admin. So these things don't happen at the factory. We've produced the product already. The product is ready to go. How do we get the product from the factory to the customer's hands? A bunch of different costs and expenses are incurred during this process, like selling costs and other administrative costs. And those we're going to call period expenses or period costs. So these costs are important for delivering the product to the customer, but they are not necessary to produce each unit of product. So whether we did this or not, spent these costs or not, incurred these expenses or not, we will still have our product. Our product will be there, but we need the janitor at the factory in order to produce our product. We need that person. So that person's salary is a product cost, but it's an indirect product cost. It becomes a manufacturing overhead cost. So let's listen to this quick video on period.
People with ADHD save 10 hours studying with this Chrome extension. But no, by all means.
What is a product cost versus a period cost? Let's discuss the accounting concepts product cost and period cost with some easy to understand examples. We will do high-level cost accounting for a hypothetical company called Toy Giraffe Inc. As the name suggests, this is a company producing and selling toy giraffes. We are going to classify various types of cost as either product costs on the left or period cost on the right. Product costs include all the costs that are involved in acquiring or making product. Product costs are viewed as attaching to units of product as the goods are purchased or manufactured. Period costs are expensed on the income statement in the period in which they are incurred. First type of cost, marketing expense. To determine whether this is product cost or period cost, we ask ourselves whether we can stick these costs to the giraffe. Marketing expense is a clear example of period cost. Period costs are not a necessary part of the manufacturing process. As a result, period costs cannot be assigned to the products or to the cost of inventory. How about depreciation? The answer here is, it depends. The company has two areas it depreciates: manufacturing depreciation for the factory and machines it owns, and depreciation on the office and its.
So of these two depreciation of factory and machines and depreciation office, in the office, which one do you think can be stuck to the giraffe as a product cost? And which one will be the period cost? Factory product, factory machines, factory depreciation is product, exactly. One that has to do with the factory, we know it's going to be a part of the product cost, right? Exactly, good job.
Its equipment. Depreciation expense for factory and machines is in product cost. Depreciation for the office is in period cost. Factory labor. This is clearly a product cost. Stick it to the giraffe. You need people in the factory to make the product. Utilities. Electricity, natural gas, water. Just like with depreciation, it depends. If we know how much electricity was used in the factory versus in the office, we can split the total utilities bill. We allocate what was used in the factory to product costs, and we allocate what was used in the office to period costs. Raw material used in production. This is clearly a product cost. You need raw material in order to assemble the product and turn it into finished goods. Research and development expenses for the next generation toys. This is a period cost. It doesn't stick to the product. We could go on and on with other types of cost, but I think you are getting the idea now. After classifying the cost as either product cost or period cost, we can take the next step in our cost accounting. Let's deal with the product cost first. We produce 100,000 units in Q1 at a total manufacturing cost of $500,000. Of these 100,000 units, 50,000 are sold in Q1, with cost of goods sold of $250,000. Cost of goods sold, in short COGS, refers to the product costs of those goods a business has sold during a particular period. The other 50,000 units go to inventory for future sales, at cost, $250,000. Inventory is an asset on the balance sheet. This is why period costs are sometimes called inventoriable cost. They remain attached as the goods go into inventory awaiting sale. Now that we have parked half of the product cost on the balance sheet, let's review the income statement. On the left are the toy giraffes that have been sold. This is the product costs of those units that have been sold, 50% of the total for each category in Q1. This is called cost of goods sold. On the right are selling, general and administrative expenses, SG&A, and research and development. We take our sticky notes from earlier on and place them in the appropriate area. Or in a more formal look on the income statement, cost of goods sold is right here near the top. If you take revenue and deduct COGS, you get to gross margin. SG&A and R&D are placed as a line item a bit lower in the income statement. If you take gross margin and deduct SG&A and R&D, you get to operating margin. I hope you enjoyed this short discussion of product cost.
Marketing and the office, yeah, that is the period cost, correct. So we know about product cost, we know about period costs. Now, prime costs are direct materials plus direct labor. So the prime costs are the costs that are easily traced to our product. Now a conversion cost, that's your direct labor plus your manufacturing overhead. Now the reason why they are called conversion costs are these are the costs that we use in order to convert our direct materials into our finished products. So you have direct materials, you use the direct labor and the manufacturing overhead in order to convert these direct materials into finished goods. Any questions here so far? Repeat. Okay. So one more time, we have a direct materials plus our direct labor plus our manufacturing overhead is equal to our product cost. This is how we find out the cost of producing our product. We add these three things together. Now, prime costs are direct materials plus direct labor. Those are our prime costs, the costs that are easily traced to the production of our products. Now, conversion cost is our direct labor plus our manufacturing overhead. And the reason that these costs are called conversion costs is because we use the direct labor and the manufacturing overhead in order to convert our direct materials into finished goods. Is the management of laborers period or product cost? Are the laborers working on the product in the factory? Now this question is for Ruben. Yes, exactly. So once you're involved in the factory, then you are going to be considered a product cost. But if you are the actual laborer, you're the one who's actually in there doing the work in the factory, touching the product, making sure everything gets done, you're touching it, you're going to be direct labor. But if you are just the manager of those laborers, you're still essential for the production of the product. You're not actually touching the product though, you become a manufacturing overhead. You're an indirect labor, which is still product cost. Is that clear? Okay, great. So let's go to your book example, page, chapter 2, page 5, I believe. See if I could pull it up quickly. Chapter 2, page 5, illustration 2.4, I believe, yeah. So assignment of costs. So the first cost is wood cores, fiberglass, and resin. Those costs are considered to be direct materials. So because we need those costs in order to produce the product, they are going to be considered product costs. Direct labor is also a product cost. Manufacturing overhead would be the factory equipment depreciation, and that would be part of product costs, manufacturing overhead. It's not easily traced. Property taxes for the factory building, manufacturing overhead. So it's a product cost. Now, when we start dealing with advertising costs, this is a selling expense. It becomes non-manufacturing or a period cost. Sales commissions selling expense. It's non-manufacturing, so it's a period cost. Factory maintenance salaries, this is manufacturing overhead. Okay, those the people who are working on maintenance in the factory, they're not actually touching the product. So there won't be direct labor, but they will be indirect labor, manufacturing overhead. Salary of the factory manager, manufacturing overhead, right? The manager is not actually touching the product, but we need him in order to produce the product. So she or he becomes manufacturing overhead, a product cost. Cost of shipping boards to customers, selling expense, because the board is already, it's done. We've produced it already. We didn't need that cost in order to produce. It becomes a selling expense categorized under period cost. What kind of expense is shipping raw materials to the factory? So that will also fall under our product cost, because we need those materials in order to produce our product. All right. So that was just a quick example of all the different costs and how we pull them into these different categories. Now, at activity, let's have a quick chat for I think 2 more minutes. What are the product and period costs associated with manufacturing Apple iPhones? What product costs do we need to manufacture Apple iPhones? Some chips, yeah, glass. The battery, hardware, okay. All right, so what about our labor? Do we need direct labor to produce that? Yeah, we'll need direct labor, okay. So what do you call those people who produce phones? Electricians? Like what do they do? Computer programmers? What are some of the direct labor costs that we'll have to incur? Tech, okay, assembly line workers, yeah. Okay, good, yep. Graphic designers, yeah, those are essential in producing the product. Now, what about our manufacturing costs? Manufacturing overhead costs, sorry. Manufacturing overhead cost of producing. Rent for the factory, yeah. Any other utilities that we have to pay in the factory, good, right? Good. Depreciation on the machines in the factory. So I think we're okay. I think we understand this. That's good. So this table right here just summarizes what our product costs. Remember, another word is manufacturing costs or inventoriable costs. It summarizes these costs there. And then over here, we have the period costs, already also called non-manufacturing costs or non-inventoriable costs. Now we notice that these are called inventoriable costs because we capitalize these costs in the product on the balance sheet as the inventory. And on this side, the period costs are expensed. So those are the ones that we will find on our income statement. Okay. And you'll see, we'll talk more about that inventoriable part of things a little bit later on. All right, so assigned question, can we jump into chapter 2, exercise 221, please? Chapter 2, exercise 221. So Caroline Company reported the following costs and expenses in May. These are the costs. I want you to tell me what's the total manufacturing overhead cost, what's the product cost, and what's the period cost. What's the total manufacturing overhead, product costs, and period costs? Chapter 2, page 37. 237. All right, part A, manufacturing overhead. Anybody came up with a number for manufacturing overhead as yet? 170,350 is the first person. Waiting for more responses from our friends. 17,640. Did you write that number correctly? I feel like I feel like it's it's very different than 170,350. Now and not later on. I got 154, 150. $173.50 for manufacturing overhead. Somebody said they're lost. Okay, that's good. That's perfect, because then now that we can fix that, right? Now we can fix that. So manufacturing overhead are the indirect manufacturing costs of producing our product. So if it's not direct and you use it in order to produce the product, then it's going to be considered manufacturing overhead. Okay, so if it's not direct costs, then it has to be manufacturing overhead as long as you're using it in order to produce the product. All right, so I have 157,700. Okay, so I got the same number as someone. I'm gonna pull up chapter 221. Okay, so this is what I got. 170,350, and I think 2 people got that. Okay, so factory utilities, as you will see, everything in here cannot be directly traced to the product, and everything in here you need it in order to produce the product. And a lot of the times the word factory is in it. A lot of the times the word factory is in it. Indirect materials, indirect factory labor, these are also needed to produce the product. This is what makes up our manufacturing overhead. Thomas, does that make more sense to you? All right. So the next question asks us to calculate the product costs, our product costs. Now, who can tell me really quickly what makes up our product costs? What are the 3 things we need to find our product costs? Direct materials, direct labor, and manufacturing overhead. Thank you, Ciara. That's exactly what we need to calculate our product costs. Now, we already calculated our manufacturing overhead, 170,350. Now, what do? We have to add the other 2 components to that. Only the direct costs of producing the product are going to be added to the manufacturing overhead. So can you drop your numbers for me as to what you think the product cost is? Knowing now that 170,350 is our manufacturing overhead amount. 337,050, 377,050. All right, lot of the same answer. Okay, so you guys are correct. Once you know your manufacturing overhead, you just add direct materials and direct labor to that, and then this gives you your 377,050. Thanks, Oshinia. I figured that it was a typo. All right, and then the last part says, what is your period cost this time? Your period costs. These are costs that have nothing to do with producing the product. In fact, these costs are expensed on our income statement. Which costs are those? Now, if you're adding anything that has the word factory in there, you're going wrong. If it has the word factory in there and it's not a direct cost, it's a manufacturing overhead cost. Think about the non-manufacturing costs. We do not need these costs to manufacture. We do not need these costs to produce. We might need these costs for selling. We might need these costs for admin outside of the factory. Somebody said 69,140. I have 65,340, 67,840, 92,900. 75,840. All right, so I'm gonna jump into it now. The answer is 69,140. So Ashutosh was correct. 3,800 for depreciation on delivery trucks. So do we need delivery trucks to produce our product? No. The sales salaries, do we need those sales persons to produce our product? No. The repairs to office equipment, do we need those office equipment repairs to produce our product? No. Advertising, do we need advertising to produce products? No. Office supplies used, do we need those office supplies to produce our products? No. So all of those non-manufacturing costs are considered period costs. Are we okay with this? How come the factory manager's salary was not included? Good question. Why did we not include the factory manager's salary? That's right, exactly. Exactly, it's overhead. Exactly. So we are going to be needing that factory manager to produce our products in the factory. What will we do at a factory with no factory manager? We need that person, or else everything's just gonna go haywire, nothing's gonna work out. All right, good job, everybody. So that's that. Another segment of cost is fixed versus variable costs. Now our total cost is equal to fixed cost plus variable costs. A fixed cost stays the same in total, no matter how much we produce, as long as it stays within a relevant range. Now, how can we picture a fixed cost staying the same no matter how much we produce? Rent. Rent for the building is $50,000 a month. We can produce 100,000 units. We can produce 10 units in that month. Do you think the landlord is going to say, oh, you didn't produce as much, okay, you can pay me less for rent this month? Is the landlord going to say, oh, you produced so much this month, you're going to make so much money, you should pay me more rent this month? So that doesn't happen. Rent, you agree upon the rent for that month, that's the rent. Now, what does relevant range mean? If you think about it, if your factory is only big enough to produce 100,000 units, and you find that this month you need to produce 150,000 units. Now, you don't have enough space in your factory, number one, to produce that extra 50,000 of product. So you might have to go and rent an additional place. You might have to rent a bigger place so that you can produce the additional units. And that's going to cause your fixed cost of rent to increase. So that's why we said, as long as we stay within a relevant range, our fixed costs will remain the same, no matter how much we produce. Is that clear? All right, so fixed cost changes per unit. Fixed cost doesn't change in total, but it changes per unit. This means that the more we produce, the less our fixed cost per unit will be. So let's assume that rent is, again, $50,000 for the month. If we produce 5,000 units that month, then what is our fixed cost per unit? Rent is $50,000 per month. If in 1 month we produce 5,000 units, what is our fixed cost per unit? Exactly, 50,000 divided by 5,000 gives us $10 per unit of fixed cost. But if instead of 5,000 units, we produce more this time, our production increases and we end up producing 10,000 units, what is now our fixed cost per unit? Is our fixed cost per unit going to be more or less? Less. So the more we produce, the lower our fixed cost per unit. But the total fixed cost per unit stays the same no matter how much we produce. Do I have any questions for this page? All right. So for example, factory rent is $600. If we take factory rent, no matter how many units we produce, we will pay the same total for factory rent. However, if we produce 100 units, rent per unit is $6. But if we produce more, 200 units this time, rent per unit reduces to $3. So we see that here in this diagram. It doesn't matter how much we produce, fixed cost, the total fixed cost is a straight line going across here. It stays the same. And then on this side, we see fixed cost per unit. The more we produce, the lower the fixed cost per unit. Somebody raised their hand.
Yes, hello. So fixed costs, are they same as sunk costs then?
Your question is fixed cost, sunk cost.
Yes, I'm saying, for instance, like rent, would it be considered a sunk cost? I mean, you're paying the rent no matter you're manufacturing anything or not. For example, during COVID, most of the locations had to shut down, but they still had to pay rent.
Yeah, that's right. Thank you.
Thanks.
So then we have our fixed versus variable costs. Okay. So hold on. A variable cost is the opposite of a fixed cost. Now, before, if I said for a fixed cost, total fixed cost does what as we produce more? What happens to total fixed cost as we produce more? Total fixed costs. What happens to total fixed cost as we produce more? Stays the same. What happens to fixed cost per unit as we produce more? It decreases. Thank you. For variable costs, it's the opposite. Variable cost now changes in total based on how much we produce. But it stays the same per unit, just the opposite, right? Variable cost changes in total based on how much we produce, but the variable cost per unit stays the same. Examples of variable costs are direct materials and direct labor. The more Tesla cars we produce, then the more steel we will need, and the higher the total variable cost will be. But the cost per unit of each piece of steel stays the same. Cost per unit, variable cost per unit of a piece of steel is the same. Okay? But the total variable cost increases the more units we produce, because that means it's the more steel we will need. Any questions there? I'm going to assume that silence means that we understand. Are we okay so far? Okay. Somebody does not understand the variable cost part of it, or fixed cost and variable costs, just the variable. Okay, repeat fixed and variable. All right, so I'm going to start with the variable one, and then I will go back to fixed. We're baking a cake. In order to bake the cake, we need flour. One bag of flour costs $2. Each cake needs one bag of flour. We want to bake a cake. In order for us to bake the cake, we need a bag of flour, and a bag of flour costs $2. If I make one cake, the bag of flour is still $2. But the direct material total cost is 2 times 1, $2. If I need to make 2 cakes, a bag of flour is still $2. The variable cost per unit is the same. But the total cost of direct material is going to increase because now I'm making 2 cakes. So I need 2 bags of flour. So now the direct material cost is $4. Now for fixed cost. In that kitchen that we're baking the cake in, we pay rent. The rent for each month is $10 a month. If I bake 1 cake, total rent is $10 for that month. If I bake 10 cakes, total rent is still $10. Heck, if I bake 100 cakes, total rent for that month is still $10. But if I want to find out the rent per unit, fixed cost per unit, unit fixed cost, I'm going to say $10 divided by the number of cakes I made. If I made 2 cakes, then the fixed cost per unit is going to go down. Does that make sense? The more cakes I make, the fixed cost per unit is going to go down. All right, great. Good. Mixed costs. Mixed costs have a combination of both fixed and variable costs. Fixed and variable together, they mix up together. It's called the mixed costs. They have both a mixed and a variable component. Sometimes called semi-variable costs. Sometimes, well, not sometimes, most times, we want to be able to separate the fixed from the variable costs in a mixed cost. Mix it up, fixed and variable. I need fixed and variable. How do I separate them? One approach to separating the costs fixed from the variable is called the high-low method. The high-low method. So now we're going to learn about how do we use the high-low method. It's really, really easy, right? And we'll see that now. And when we're finished learning about the high-low method, we're going to take a break because we learned too much. Okay? So let's try and finish learning about the high-low method in 8 minutes. Can we do this in 8 minutes? And then we take a break. So one approach to separate the cost I said before is the high-low method. So you're using the total cost incurred at both the highest level of production and the lowest level of production, right? You're using the total cost incurred at the highest level and the total cost incurred at the lowest level. The difference in cost between the high and the low levels should be your variable costs, since only variable costs change as activity levels change. What does that mean? Let's move on. Let's see it in practice. If I talk about it, you're gonna get confused. So let's look at how we actually apply it. So step 1 in the high-low method, we say determine the variable cost per unit using the formula below. So change in total cost divided by the change in activity levels is equal to the variable cost per unit. Once we know the variable cost per unit, we can find the fixed cost by subtracting the total variable cost. By subtracting the variable cost, the total variable cost, from the total cost. And then that will tell us what our fixed cost is. How does this look in practice? So look at this table right here. we see that there's January, February, March, April. This is data for a metro transit company for the last 4-month period. Kilometers driven. In January, 40,000 kilometers. In February, 80,000 kilometers. March, 70,000 kilometers. April, 100,000 kilometers was driven. Back to this, can you take a picture of this slide for me, please? 3, 2, 1. I'm just imagining that there's picture sounds happening right now and everybody is finished taking a picture. So the first part of the equation says the total change in total costs. So the total cost, the highest total cost minus the lowest total cost. What's the highest total cost? At the highest level, sorry, what's the highest level? 63,000. 100,000 kilometers has $63,000 of total cost. And then the other one was what? What's the lowest one? 40,000 kilometers at $30,000 total cost. Yeah, okay. So we're looking for the highest activity level and the lowest activity level. Highest cost at that level, lowest cost at that level. Okay, so we can find the change in total cost and divide it by the change in activity level. Kansas says the highest is in April and the lowest is in January. I'm going slowly so people can see. Can you see this? Christina says, yes, I can see this. Okay, so what is the change in total cost? Great, what is the change in activity? Great, so once we divide our change in total cost divided by change in activity, we get the variable costs per unit, per kilometer in this case. Variable cost per kilometer. So if we were to multiply the variable costs per kilometer by one of these, then we can get total variable costs. And then we can deduct it from a total cost to come up with our fixed cost. So you just pick one. And we'll see that on the next slide. They use both of them to show you can get the same answer. Total cost is 63,000 and 30,000, right? We found those. And we also found that the variable cost per unit is 55 cents. We can multiply that 55 cents by 100,000 kilometers to get 55,000 kilometers, or, sorry, $55,000, or we can multiply the 55 cents by 40,000 to get $22,000. And this represents our total variable cost, these two. So total cost deduct our total variable cost is equal to our total fixed cost. Any questions here? Anybody lost about the high-low method? We're all good. I was found onto the last part. Which part is not good? This part here, we're finding the total fixed cost. So you're fine up to here, right? 55 cents. You found the 55 cents. Good. So what we found here is a 55 cents variable cost per unit. Okay? 55 cents variable cost per unit. Now, how do we find our total variable cost? We must have to multiply it by some kilometers because it's 55 cents variable cost per kilometer. So we have to multiply this 55 cents by some kilometers. Correct, Tala? So pick one of the kilometers. Which one do you want to pick? Pick any one, 100,000 or the 40,000? 100,000 times 55 cents will give you the total variable cost at the highest level. That's $55,000. And we know that the total cost, because it told us, is $63,000. So total cost less variable costs equals fixed costs. 63,000 less 55,000 equals fixed costs. Total cost is made up of two parts, a variable part and a fixed part. So if we know what the total cost is and we know what the variable cost is, then the difference is what's left back is the fixed cost. Is that clearer? Okay, great. All right, perfect. So let's take a break now. It's 8:31. We went 1 minute over. Let's take a break now and come back in 10 minutes at 8:41. So just a quick example here. It says, what if the activity level is 45,000 kilometers? And we know that the estimated maintenance cost would be $8,000 fixed. How would you calculate how much is the total variable cost? So we calculated before the variable cost per unit of 55 cents. We're gonna multiply that by the 45,000 kilometers to get our total variable cost. Our total variable cost plus our fixed cost of $8,000 will give us our total cost. Question, variable costs are costs that vary in total directly and proportionately with changes in the activity level, remain the same per unit at every activity level, neither of the above, both A and B above. Which do you think is the answer? Correct. Both A and B are correct. So it varies in total. The more you produce, the higher the variable cost. The less you produce, the lower the variable cost. But the variable cost per unit remains the same at every activity level. And then remember, the fixed cost is the opposite. So for the two questions that we had assigned for today would be BE28 and BE211. So BE28 and BE211, let me jump over to the textbook. So 28. So Westerville Corp has collected the following data concerning its maintenance costs for the past 6 months. Calculate the variable and fixed cost components using the high-low method. Perfect, you get to practice this. So I'm going to give you, if the time is 8:45, 5 minutes should be enough to calculate the variable and fixed cost components. So at 8:50, we will take this up. You know what I'm gonna do? I'm gonna put you in breakout rooms for this one. So if you don't have the textbook as yet, can you take a quick picture of this page? And then I'm gonna put you in breakout rooms for 5 minutes. To work on this, when we come back to whole group, we will discuss the answer together. Okay, great. So would someone want to drop in the chat what they got for variable and fixed cost components? Someone from each group? What did you get for the variable and the fixed cost? Kansas group got 5,000. Fixed cost 5,000. Variable 1.50 per unit. Okay, so what was your total variable cost? And that's very important. You have to really read, is the question asking for a variable cost per unit, or are they asking for a total variable cost? Okay. All right, so everybody seems to have gotten the same answer. Now let's jump into okay, so our equation, we know the change in total cost divided by the change in activity. So the change in activity at the highest, we have to pick the highest level of activity, which was 40,000, and the lowest level of activity, which is 18,000, and the corresponding total cost for that. So at 40,000, which is the highest, the total cost is 65,000, and at 18,000, which is the lowest, the total cost is 32,000. So $33,000 divided by 22,000 units gives us $1.50 per unit, right? So what we do here is that we can now calculate what our total variable cost is because we have this per unit figure. So $1.50 multiplied by the highest activity, the highest number of units, and 1.50 multiplied by the lowest number of units. This will give us our total variable cost. Once we can deduct our total variable cost from a total cost, we'll end up with our total fixed cost because total fixed cost plus total variable cost is equal to total cost. Okay, so the mixed cost is made up of $5,000 of fixed costs, total fixed cost, plus $1.50 per unit produced. Okay, so I think everyone who gave an answer were on the right track. Okay, and it's important to understand you have a per unit amount. Do you know the difference between a per unit amount and a total variable cost amount? All right. Good job. Anybody has questions? I think it was Samin who was a little confused. Are you clear now? Yes, that can happen. That can happen, right? You're looking, you first, you want to look at the highest activity and the lowest activity. Okay. But I think for the purposes of this course, it'll always line up, right? You'll always have the highest having a high total cost and the lowest having a lower total cost. Okay, all right, good. Now, question 211, we're gonna take that up now very quickly before we move into the, it's the more abstract part of this lesson. Okay, so 211 says Marvel Manufacturing Inc. provides you with the following data for the month of June. Prime costs were $195,000, conversion costs were $140,000, and total manufacturing costs incurred were $270,000. All these terms we know now. Beginning and ending work in process inventories were equal. Selling and administrative costs were $200,000. What were the total costs of direct materials used, direct labor, and manufacturing overhead? So take about 5 minutes to work on parts A, B, and C of this question, and then we'll take it up quickly. Can we take a picture of this over here, this diagram here? I don't know how to solve this. Yeah, it's a little bit complicated. Take a picture of this here, where we see what makes prime cost, what makes conversion cost. Okay, we're gonna refer to this when we are working through that. All right, so They tell us that prime costs is $195,000, and we know prime cost is direct materials plus direct labor. And conversion costs are $140,000, and we know conversion costs are direct labor plus manufacturing overhead. And total manufacturing cost includes direct materials plus direct labor plus manufacturing overhead. So they've given us a bunch of different parts, and they've given us parts that kind of overlap, and we have to figure out how to separate them and work with it, okay? So let me pull it up really quickly. So if we look at question 211, I don't want to show everything. All right, so prime cost is, I'm going to put in brackets, direct materials plus direct labor. Conversion costs are made up of direct labor plus manufacturing overhead. And then total manufacturing costs is made up of direct materials plus direct labor plus manufacturing overhead. So when we look at this, we notice that direct labor is repeated here, okay? And then direct materials is repeated there. So if total manufacturing cost includes all of these components, how would we figure out how much is direct labor? Well, what we can do is we realize that we can deduct our total manufacturing costs from our $195,000 plus our $140,000. So our prime cost and our conversion costs. So we can deduct our total manufacturing costs from our prime and our conversion costs. Basically, we take out this because direct materials, so we deduct it, so we take it out, and then deduct direct labor, so we can take that out, and then deduct manufacturing overhead, so we take that out. And what's left, what is left once we've deducted our total manufacturing costs is our direct labor. So that amount is $65,000. A little bit confusing, I know, but it's more math, it's mathy. This one is giving a lot of math. All right. Now, if we know that our direct labor is $65,000, and we want to figure out what our direct materials is, knowing that direct labor plus direct materials is our conversion cost, direct labor plus manufacturing overhead is our conversion cost, prime cost, direct labor plus direct materials, conversion cost, direct labor plus manufacturing overhead. And we know that our direct labor is $65,000. So how can we find our direct materials? What can we do? Prime cost is $195,000. So we know that prime cost is equal to direct materials plus direct labor. Prime cost is $195,000 is equal to X, we don't know, plus 65,000. What is direct materials? Exactly, right? Does that make sense? 195,000 minus 65,000. So direct materials is $130,000. So if we know what our direct labor is, our direct materials is, what is our manufacturing overhead? We know direct materials, we know direct labor. What's manufacturing overhead? Anybody can figure that one out? Correct. 275,000 minus 195,000, because we're saying our total manufacturing costs deduct our prime cost will leave us with our manufacturing overhead. Very good. And then that will give us our $75,000. Another way that they did it here was they said conversion costs, take away direct labor. Your way is going to give you the same response. Okay, Kansa?
Yes, thank you.
All right, great. So the second part of the question now is asking us, can we calculate what our total cost of production is? Basically, it's just different words, but it means the same thing. What is our total cost of production? What are the three things we need to calculate cost of production? We need three things to calculate the cost of producing our goods in the factory. The first thing is direct materials, direct labor, manufacturing overhead. So what is our total cost of production? They told us in the question already. Total cost of production is 270,000, perfect. And then what is our period costs? Now remember, those costs are costs that we don't use to produce. We don't need to produce goods with those costs. And what's our period cost here? $200,000, very good. All right, okay. Good stuff. This is the part now. This is the part now. Everybody needs to like stretch. You gotta stretch for this part. So in financial accounting, remembered a statement called the income statement that was showing us profit. That income statement that we did was for a merchandising company, a company that buys goods and then just sells them over, like H&M. They buy clothing and they sell them over. Do they? Or do they produce their own clothing? A company or a business that buys their own goods and then they just sells them over. That's a merchandising business, okay? But in this chapter, we're going to be focusing more on manufacturing organizations. They produce their goods and then they sell them over. So the income statement of a merchandiser and a manufacturer have similarities, yes. But the cost of goods sold section is different. Who can tell me, since your exam is coming up, what is the formula for cost of goods sold in the income statement that we've learned in the financial accounting part for a merchandising company? How do we find cost of goods sold? What do we start with to find cost of goods sold? Beginning inventory, thank you. So beginning inventory, and then what do we add? Purchases, and that gives us the cost of goods available to sell. And then what do we do next? We less our ending inventory, And that gives us our cost of goods sold. Amazing, perfect, perfect, perfect. Now, what we're saying is in a manufacturing organization, the way we get to cost of goods sold is going to look different. It's going to look different. This is how it looks different. In a merchandising company, a merchandising business, you purchase, right? You purchase them. You have your product inventory. And once you've sold stuff, then you come up with your cost of goods sold, right? But in a manufacturing company, we don't just have one inventory. We have three. In a manufacturing company, there are three different types of inventory. The first one is our materials inventory. So our direct materials inventory. Then we have a work in process or a work in progress. Work in progress. We're all a work in progress. There's a work in progress inventory, and then there is a finished goods inventory. So let's look at this diagram. We purchase materials in a factory. We need to purchase direct materials, and we store them in a materials inventory account. Or let's picture a physical place in our factory where we're going to put all of our direct materials that we've purchased. And then somebody says, it's time for us to bake our cake. Let's use the cake. So we have purchased flour, sugar, oil, eggs. Flour, sugar, oil, eggs. We've purchased those 4 raw materials. And then we've placed them in a raw materials inventory room. That's where all of our ingredients are for our cakes. And somebody calls us up and they say, we need a birthday cake by tomorrow. We say, all right, no problem. So in order for us to make that cake, what do we need? In order for us to produce that cake, what do we need? We need raw materials, we need labor, and we need it's the third part that we need. Manufacturing overhead. Exactly. We need our overhead. So I'm going to go into that room that I have my ingredients, my direct materials inventory, and I'm going to take out what I need. And then I'm going to call up my baker and I'm going to tell him, I need you. And then as usual, we have the overhead that's there constantly working. So once these 3 things start working together, the direct materials, where we took some of them from that room with all our direct materials, all of our ingredients, we took what we need for the cake. We got the baker, he came in, he said, yeah, I can work this day. And then we have our overhead. They're all working together to bake the cake. The cake doesn't just magically finish. We just don't put raw materials. We just don't put the baker there and the overhead, and then all of a sudden in 2 seconds, you have a cake. No, what happens is that cake is gonna be in progress. Your cake is in progress. We're making it, we're assembling everything. It's in progress. Once that cake is finished, it's going to move in to our finished goods inventory. When we sell that cake, the person comes, picks up the cake, then the cake moves into the cost of goods sold. So you see how much we have to do in a manufacturing company before we can get to cost of goods sold? Because it's not just simple, buy the product, sell the product. It's buy the materials, make the product, sell the product. Lots of things have to go on there in a manufacturing company. So this is what the difference is. You told me beginning merchandise inventory, add the purchases, less ending inventory, cost of goods sold. This is the one we know. This is the one that's different now. Beginning finished goods inventory, right? What do you think is in the beginning finished goods inventory? What's in beginning finished goods inventory? The cakes that are finished from a previous period, right? All the cakes that were done from a previous period that we didn't sell, they're gonna come into this period as the beginning finished goods inventory. Those cakes are finished, they're done. They're not in progress. Plus the cost of goods manufactured. This means that this is this right here. Cost of goods manufactured is right here at this point. Once we've finished working on our goods, we're finished our cake, cost of goods manufactured moves into finished goods inventory. So the cakes that are finished from the previous period, plus the cakes that are finished this period, less the ending finished goods inventory, which means the cakes that are still in inventory at the end of the period, means the cakes that we did not yet sell, tells us how much we sold. Does that make sense? Okay, so let's watch this.
Cost of goods manufactured is the cost a company incurs to make the goods that is going to sell as finished inventory. Let's look at the formula for cost of goods manufactured. It's equal to the direct materials that are used to make the item, plus the direct labor that's used to build the item, plus any manufacturing overhead that's allocated to it, plus the beginning work in progress in inventory, minus the ending work in progress in inventory.
So essentially, what is another way of thinking of a cost of goods manufactured? How much did it cost to produce the goods that we finished in this period? How much did it cost us to produce the goods that are finished in this period? So it's January. We need to make 10 tables. We need to build 10 tables in January. That's how much we're building in January. From December, we had some tables that are finished, still left over in finished goods inventory. Let's say 2 of them. All right? When those finished goods come into January, are those goods that we have produced in this period? If we bring in goods from December into January that were finished already, can we count those as the goods that we manufactured in January? No, we finished those in December. So the cost of goods manufactured in December stays in December. So the cost of goods manufactured in January is the total cost incurred to manufacture those goods in this specific month, in January. But if you look here, we're talking about direct material used in this month, in this period, plus the direct labor used in this period, plus the manufacturing overhead used in this period. Why are they adding a beginning work in progress? The beginning work in progress are tables that were started in December, but we weren't finished building them. So we have to move them over to January, and we're going to finish them in this period. So that is why we see a beginning work in process inventory added in calculating the cost of goods manufactured. But then we deduct our ending work in process inventory from that amount, because we're only interested in the cost of goods manufactured, the cost of things that are finished and completed in this period.
So what is the direct materials? Well, that's the beginning inventory plus any purchases minus the ending inventory of raw materials. And in terms of labor, it's going to be the number of hours worked multiplied by the hourly rate. Let's look at an example to see how this works. Here's a schedule for cost of goods manufactured. A company with a fiscal year end of December 31st has direct materials with a beginning inventory of 25,000. It then purchases 9,800 more raw materials, and we deduct from that the ending inventory of 23,000. So we know that the direct materials used in production is 11,800. Think of it this way: if the company wants to figure out how much it spent in production, and it knows that it purchased 9,800 of raw materials, and it ends the period with less inventory than it started with, it must have cost or spent more than 9,800. If it ended the period with more inventory than it started with, it actually would have spent less than what it purchased of 9,800. That's the general concept with opening and ending inventory balances versus purchases. We then add to that the direct labor, the number of hours worked times the hourly rate, and we add to that the manufacturing overhead that's allocated to producing goods. There we have our total manufacturing costs, 55,800. Next, we take the beginning work in progress inventory and we deduct the ending work in progress inventory so that we get the total cost of goods manufactured, 53,700 in this case. Now, let's compare that to cost of goods sold. If we add the beginning finished goods in inventory and deduct the ending finished goods in inventory, we can see that the cost of goods sold then for this same period was 54,400. Remember, the cost of goods manufactured are just the goods that are created and ready for sale. The cost of goods sold is the cost of the units that are actually sold to customers.
Thank you. So the reason that we're calculating our cost of goods manufactured is because we want to calculate a cost of goods sold. So in the beginning of the period, we started off with two tables that were finished that came over from December. In January, in addition to those two tables in finished goods, we also produced and finished 10 more tables. So we have 12 tables that we've completed 12 tables. And of those 12 tables, at the end of January, we only have 3 tables left in finished goods, in ending finished goods inventory. So how much tables did we sell? What's our cost of goods sold? We started off the month with 2 completed and finished tables in January. During January, we finished manufacturing 10 tables. So we have a total of 12 tables available to sell. And then in ending inventory, ending finished goods inventory, we realized we only have 3 tables left. How much did we sell? What's the cost of goods sold? Very good. So 12 take away 3, so 9.
Cost of goods.
So how to build a cost of goods manufacturer statement. So for your midterm, midterm number 2, you will not have to create this. Or midterm number 2, I believe, is also going to be a multiple choice. But you might have to come up with a cost of goods manufactured figure. How do we calculate that? Or how do we calculate the cost of goods sold figure? So understanding how to complete different parts of the cost of goods manufactured statement is what you're going to have to be able to do. Total manufacturing cost includes all of the resources used in production for products completed and still in process. That's total manufacturing cost. Not just the goods that are completed, but also those we're still working on. All of that for that entire year is our total manufacturing cost. Our completed goods plus our incomplete goods is equal to our total manufacturing cost. Cost of goods manufactured or completed, it's different. We only care about the goods that we have produced and finished in this period. From that cost of goods manufactured, from that finished goods inventory for that period, some or all of those units are sold. These sales will lead you to a cost of goods sold. Any questions? I know this part is very abstract. You're gonna have to listen to this recording when I post it and go over your slides and your textbook a few times before you can get it, right? I don't expect you to understand everything I'm saying in this one lecture. So that's the perk of having this recorded. So let's just run through this diagram really quickly. The materials inventory is where we bought our ingredients for our cake. And we have them stored here in materials inventory. We have our labor, wages payable, we have overhead. Okay, these are the 3 things we need for product cost. In order for us to bake our cake, we need materials, labor, overhead. Work in process inventory, we wanna create a cake, right? We wanna bake a cake. So in the work in process, we'll have a cake that's not yet done from a previous period, right? We're still working on it. Maybe we baked it December 31st and January 1, we're gonna decorate it. So it's not yet done. So it's still in work in process, work in progress. But we need to bake other cakes. So we put in some raw materials, 75. We put in some labor and we put in some overhead. And once we've worked on this, we're working on baking our cakes. $215 worth of the cakes is finished. Now in our finished goods inventory, we already had a finished cake there. Finished cake from before plus the finished cakes from this period. That's in our finished goods inventory. When people buy the cakes, the cost moves out of the finished goods inventory, cost of goods manufactured, and it goes into the cost of goods sold. Do we even understand the flow of cost, how it's moving, how we get to cost of goods sold, why we need to calculate the cost of goods manufactured? Kind of, okay. So again, it's not gonna be perfect after just this one lecture. We're gonna have to go over it again. All right. So what I did here to help you on this slide is I put the steps that you need. These steps will help you in figuring out how do I build a cost of goods manufactured statement. So step one, we have our beginning work in process inventory. Remember, those are the products that are not yet complete, but they came in from a previous period. Then we add the work that we're going to start this period. So we have beginning work in process plus the total manufacturing costs from this period, which will be direct materials, direct labor, and overhead from this period, will give us a total cost of work in process for this period. Whenever we're done and finished our goods in the work in process, they leave work in process and they go into finished goods inventory. This is our cost of goods manufactured. They are waiting now to be sold. Once they are sold, they leave the finished goods inventory, and this becomes our cost of goods sold. Beginning finished goods inventory from a previous period, plus the cost of goods manufactured, that means that these are the goods we finished producing in this period, less the ending finished goods inventory, what's left back can tell us the cost of goods that we sold. And this is just a quick synopsis of exactly what the statement of cost of goods manufactured looks like. So we take the cost of goods manufactured amount that we calculated, and we put it into our income statement. Beginning finished goods plus cost of goods manufactured equals cost of goods available for sale less ending finished goods equals cost of goods sold. So this is the point of creating a cost of goods manufactured statement. We just need to be able to calculate our cost of goods sold. Merchandising companies are lucky. They don't have to go through that because all they have is purchases. We don't have purchases here. We have cost of goods manufactured. Okay? So what we're gonna do is I want us to look at chapter 2, exercise 237 together. Chapter 2, exercise 237. So the following information is available for a sassafras company. Calculate the cost of goods manufactured. So they give us a beginning raw materials inventory. They give us the ending raw materials inventory, work in process inventory beginning, work in process ending, finished goods inventory beginning, finished goods inventory ending, materials purchased, direct labor, manufacturing overhead, and sales. Calculate the cost of goods manufactured. Remember, cost of goods manufactured means cost of goods that have been completed in this period. So what does that look like? 237. Can you take a picture quickly of this slide where I have the steps here, breaking it down? All right. So the first step is we have our beginning work in process inventory. It comes in from the previous period, and that's what they did here. Work in process inventory of $13,500. Okay. Then the next step that I have here is we are going to add the work that we started in this period to the beginning work in process inventory. What did we start in this period? So the first thing we need to know is that in order for us to do work in this period, we need three things. We need direct materials, we need direct labor, and we need manufacturing overhead. How much of our direct materials did we use in order to produce in this period? Well, we have to realize that we brought in raw materials from before. So in our raw materials inventory, we have 21,000. We purchased more raw materials this period. So the total materials available for use are 171,000. The ending raw materials is 30,000. That must mean we used $141,000 of raw materials in this period. Does this make sense so far? Just this part. Following these steps here, we start with our beginning work in process, and then now we're going to add our total manufacturing costs. Does this make sense so far? Kansas says yes. Yes, Jacqueline, perfect. Okay. So since we know our work in process beginning, and we know we're trying to find out the total manufacturing cost, what work did we add in this period? We added some work in this period. So we found out how much direct materials we used in this period. And then we know that we used 220,000 of direct labor and 180,000 of manufacturing overhead. Our total manufacturing costs in this period is $541,000. Remember, I told you, total manufacturing cost includes not only the goods or products we are producing in this period, but also the goods that we brought over from the previous period that are not yet complete. Okay. So good so far? Okay. So once we have the total cost of the work that we're trying to get through in this period, our total cost of work in process, we're trying to finish these goods in this period. We may not finish them all. We may have some of them left over that's still not done, that's gonna go over in the next period. And we do actually, our work in process at the end is 17,200. So how much of that 554,000 of the 554,000 we're trying to finish in this period? We're trying to finish, we're working on it. We're working on it really hard. We realize at the end, the period is up, time's up. What's left still to be worked on is $17,200. So what is the cost of goods that we have finished? What is our cost of goods manufactured? $537,300. Now, who remembers what we do with the cost of goods manufactured figure? Why do we need a cost of goods manufactured figure? We need to put it into what statement? Which statement needs a cost of goods manufactured figure? Anybody knows? The income statement, thank you. So we need to put that cost of goods manufactured figure into our income statement. So we have sales revenue less cost of goods sold. We're trying to find out the cost of goods sold amount. That's why we use the cost of goods manufactured. Can we sell goods that are not finished in the work in process inventory? Can we sell those? Can we sell the goods in the work in progress? No, we can only sell the goods in finished goods inventory. So that's why when calculating the cost of goods sold, you see that we switched to a finished goods beginning inventory of 27,000. We add the cost of goods manufactured in this period, gives us the cost of goods available for sale. And we deduct the finished goods that are still left back at the end of the period. That will tell us our cost of goods sold. Cost of goods sold deducted from our sales revenue gives us a gross profit or a gross margin. Okay? How do we feel? That's it. That's it for chapter 2. It is a lot. I know. Honestly, I'm very, very sorry about how much we are expected to cover in each class. But it's a really rigorous course, and I think it's because it's required for the HR certification. So we had to try to fit as much information as possible in there so that this course is accepted. Trying my best. All right, so you can just look it over after, just look it over after when you're studying, and it should help if you can see it over again. Now, really quickly for the next 3 minutes, I'm gonna guide you through what you need to look out for in chapter 1. So in chapter 1, and I've already put in lots of YouTube videos, and it's good for studying, okay? So we need to know what's the difference between managerial and financial accounting, and we talked about that in our first lecture, I believe. Okay, having an understanding of what the managerial accounting definition is good. It might help you in a multiple choice question in your second midterm. Now we know that this shows that there are 3 functions of management. Management is responsible for planning. That means that we have a strategy, a business has a strategy. This is a long-term goal of what they want to achieve. Like if they want to be a cost leader, right? We want to have the best cost, the lowest cost we can give our customers the best prices. Now, what we're going to do in management accounting is that we need to come up with all of the goals and the short-term plans and the objectives that will help us to one day achieve our long-term goals. So we have plans, we set goals. In directing, we want to implement these objectives and execute these goals. In controlling, we're looking at, did we meet our targets? Did we miss our targets? And if we did miss our targets, what can we do in order to get closer to them next time? All right. Then we have an organizational structure, knowing exactly the different parts of the organization structure can also help you in your midterm as well. Then there are a few points on business ethics. So I basically just put on this slide 5 points that you need to know. You need to know about the Code of Ethical Standards, corporate social responsibility, and all of these are all theoretical terms that you can just read in your chapter number 1. And then I gave this slide, which is a list of 1, 2, 3, 4, 5, 6, 7, 8 concepts. And all of these concepts are explained in your textbook. I also have given you a couple of slides for each one of those concepts and YouTube videos that you can watch to help you to understand them even more. So value chain analysis, technological change in the modern managerial accounting, theory of constraints, enterprise resource planning, activity-based costing, data analytics, total quality management, lean accounting, just-in-time inventory methods. All of these terms are going to be looked at in more detail as we go through the different chapters in managerial accounting. All right, so it's just this chapter 1 is just an introduction. I would suggest when you're studying, learn the different concepts that I've mentioned in these slides and get familiar with them as well. All right, so that's it for chapter 1 and chapter 2. Now, I wanted to jump quickly for the last 5 minutes, 6 minutes of class to talk about the midterm number 2. Yes, these slides are all for midterm number 2, not for midterm number 1. Midterm number 1, we finished all of the material that we need for that last week. All right. If you have any questions pertaining to the midterm, please feel free to let me know. We have talked about the accounting equation, right? Understanding what happens in the accounting equation from different transactions. Okay, we've talked about our income statement. You know how to calculate cost of goods sold. You know how to work with a balance sheet. You know the different parts of the balance sheet. You know about the retained earnings statement. You know about your financial ratios. All of those concepts are going to be tested in your midterm. So just being able to go over your week 1, week 2, week 3, those 3 lectures, you can choose my lectures to rewatch. You can rewatch Taslima's lectures. You can do a combination of both because there are things that Taslima goes into detail in that I don't, and vice versa. I wanted to show you something. Midterm number 1, practice midterm. You will have your formula sheet, so don't worry about that. Understanding the different conceptual framework terms like relevance and going concern and faithful representation, all of those things we've talked about, go over them, understand them. Go through both of your practice midterms. Practice both of your midterms. Go through all of the questions that were assigned. So the midterm 1 review will be in tutorials on Saturday. Remind me, what time is your tutorial on Saturday? Is it like 11 o'clock? Okay, so at 11 o'clock, I must message David and ask him to prepare a midterm for you at 11. That way you have 1 hour of, any questions that you need and a couple of questions he'll go over, and then you should be ready for your midterm on Saturday. All right. Okay. Good luck, everybody. Please, please, please study. I really, really want to see everyone in this section do very, very well. All right. If you have any questions, I'm going to stay back for like 10 minutes after class for anyone who has questions on midterm number 1 stuff. I'm willing to help you. Also send me emails. I'm really good with answering emails. So if you have questions with email, ask me, ask David McIntosh. He can help you as well. You're welcome so much, everyone. Have a very, very good night and good luck again.
Hi, I have a question.
Yeah.
If possible, throughout the week, if we are going over just practicing for the midterm and we come up with a question later on, are we able to schedule a Zoom meeting with you throughout the week or no?
Yeah, so I have office hours on Wednesday. So I have
yes.
Remember that? Yeah, so you can just email me and let me know that you want to schedule a spot in the Wednesday from 6 p.m. to 7 p.m. I'll be available there. There's also the discussion forum. Please feel free to drop your questions in there. The professors are available to answer those questions. Your peers can answer those questions. David can answer those questions as well.
Okay, thank you.
You're welcome.
And sorry, one other question.
Yeah.
You mentioned how nobody's midterm will be harder than the others. I was curious what you meant by that. Like we're all not taking the same midterm basically.
So yeah, so basically it's like this e-class allows us to set up the midterm in a way that reduces the chance of academic dishonesty.
Okay.
So we have a pool of a thing of questions that Taslima and I have created together. And basically it's going to be kind of randomized. So everybody is just going to have their own midterm. So
There's just like no harder version,
no,
right?
it's not going to be harder. It's just going to
Okay.
be, it's going to be the same type of complexity of questions for everyone.
Okay.
You're just going to, it's just going to be different.
Okay. And I was doing the practice like portal to access the test. Sorry, this might be like a stupid question.
No, no question is stupid.
Basically it's just like you click the answer, and once you've clicked the answer, there's no going back from it.
Right.
Okay, so be very careful before clicking the answer.
Yes. Be very
Okay.
careful before pressing submit for your answer, because you cannot go back, right? And a couple of students rightfully were not happy with that, but it's just the policies of having an online exam, right?
Yes, of
Just,
course.
yeah.
Also, I'm so sorry, I keep asking so many questions.
No, it's okay. Keep going. You're helping other people. I'm sure they have the same questions as well.
The weight for this midterm can be found in the course outline, correct?
Yep. So the weight for it can be found in the course outline. And for people who missed the first midterm, it's going to be transferred over to your second midterm, but your second midterm is going to cover the concepts of midterm 1 and 2. So yeah, so basically it'll be a cumulative midterm 2 if you missed midterm number 1.
Okay, sounds good.
You're welcome.
Thank you so much.
You're welcome. Good luck.
Thank you. Have a great week.
You too. So Tharun says, I'm finding the quizzes difficult. That's not good. So after attending lectures, Tharun, after practicing the assigned problems, after going through your textbook, going through your slides, you still find them difficult?
Yeah, like I do. I downloaded the textbook off of the Captus website, and I attempted the practice questions, and I do like 2.1 sections throughout the textbook, and then I just rewrite everything, and then I take lecture notes as well, and I'm still finding it like the application kind of questions, the calculations part difficult.
Okay.
But the worded questions, I'm finding it very easy to do. It's just the technical part.
Okay. So can you give me, obviously you can't give me the technical question from your quiz, but can you give me a topic? Is it the accounting equation? Like exactly which kind of question is confusing to you? Maybe we can do one really quickly together and see if it'll help.
Yeah, I noticed that it has to do with anything that has to do with the balancing sheet. Any question regarding like how just reading the question, like understanding what the transactions are saying and knowing if it's an asset or an equity. I'm having difficulty understanding liability terms.
Okay, so you're having difficulty understanding if something is an asset, is it a liability, or is it equity?
Yeah, so for that reason, I'm having issues balancing the entire sheet.
Mm-hmm. But for your quiz, are you expected to balance anything?
In the quiz, the first quiz that I did have a couple of questions asking about calculations.
Mm-hmm.
It was asking if liabilities will remain unchanged, if assets will increase by 3 million, stuff like that.
So that sounds like an accounting equation issue, right?
Yeah.
So it seems as though maybe you're having problems understanding how the accounting equation works.
Yeah.
Okay, so any of these questions here, investors buy shares in Quietus Limited for $5 million. On day 1 of the company's operations, $3 million is spent on assets and $4 million is borrowed from the bank. The accounting equation at that point in time is, would you find a question like this difficult?
Yes, somewhat difficult.
Okay, so let's see if we can break it down together. Investors buy shares in Quietus Limited for $5 million, right? What's going to happen if they buy shares for $5 million? What's happening to our accounting equation? We know that assets is equal to liabilities
plus
equity, right? So that's literally what I'm writing down, okay?
Yeah.
So investors buy shares in Quietus Limited for $5 million. So $5 million, like how does that affect your accounting equation? What do you think happens if they buy shares from us?
Assets will increase by 5 million.
Right, so we're gonna get cash. So assets is gonna go up by 5 million. And then on the other side of the equation, something else needs to happen so it balances.
Equity.
Equity, good, because shares is equity, right?
Yeah.
So right now we have 5 million assets, 5 million equity. On day one of the company's operations, 3 million is spent on assets and 4 million. Okay, so 3 million is spent on assets. What happens?
So assets will go down by 3 million
Assets
and equity
Mhm.
will go down by 3 million and liability 4 million. And it would be on credit.
Okay, wait.
Okay.
Wait, we're going too fast. This is how we get confused.
Okay.
So all we want to talk about right now is $3 million is spent on assets. So forget about assets now, forget about liability and equity. Let's just be real. If you spend $3 million and you buy a Gucci bag, right? You buy a Gucci bag for $3 million. What are you going to get? What do you get in your hand?
The bag.
Get a bag, right? That's
Yeah.
what you get. What do you lose?
Money.
Money. So if $3 million is spent on assets, you lose $3 million in cash, but you get a $3 million worth of an asset, right?
Yes.
So does the accounting equation change? Can you see this?
Yeah, I see.
So assets is equal to liabilities plus equity. First, we sold shares, so we got $5 million in cash, and then we got our 5 million equity, right?
Yeah.
Then we have to buy $3 million in assets. So we spend 3 million, right? We spend 3 million here. So cash goes down, but also we get an asset. So like our Gucci bag. So the asset goes up.
Oh.
So if asset goes down and then asset goes up, then nothing happens, right? See how nothing happened there?
But how do you know when it's a cash transaction without it having the word cash in it? That's a weird question.
Okay, so if it says $3 million is spent on assets, it means that you use cash. If they didn't specify, if they didn't say on credit, right?
Yeah.
Or on account, if they say on credit or on account, it means you didn't use cash. It means it's a liability.
Yeah.
Right? So far, so good, right? $4 million is borrowed from the bank. If we borrow $4 million from the bank, what happens? What do we get? You go to a bank, okay? Don't overthink this, Tarun. You go to a bank and you borrow $4 million. What do you get?
Money.
You get money. It's an asset. You get cash. So $4 million goes up in cash, right?
Yeah.
But what else happens?
Liabilities.
A liability, right?
Yeah.
The accounting equation at that point is what?
Okay, so 12 million is equal to 4 million plus 5 million.
Right. So you see how I broke it down? I did a piece by a piece by a piece.
Yeah.
So I think what you're doing is you're overthinking. You're like assets and liabilities and equity and debits and credits and all of this stuff. It's confusing, right?
Yeah.
But I want you, when you're reading these things, to think about yourself. You are the business, right?
Mm-hmm.
So if you go into a bank and you borrow $4 million, you're getting $4 million in cash. Thanks. But oh, shoot, now I owe you $4 million, and that's a liability when I owe.
Got it.
Right?
Yeah.
So whenever you figure out what happens on one side of the equation, you got to find out what happens on the next side so it stays balanced. But just like the $3 million that was spent on assets, sometimes something happens on one side of the equation and it happens again on the other side, but it's the opposite. So it cancels out, it's zero.
Yeah.
Right? Do you want to try number 8?
Yes.
So after a year of operation, BlackFi Limited has $1 million in assets, 300,000 in liabilities. All right, so you write it down too. Assets is equal to liabilities plus equity.
Okay.
Right, write down that equation. And then below it, it says $1 million in assets, okay, and 300,000 in liabilities. So right there and then, what does your equation say? $1 million is equal to 300,000
plus 700,000.
Exactly, because if it was plus 0, it will be wrong. Because
Yeah.
1 million cannot be equal to 300,000. It has to be the same on both sides.
Right.
So that's how we know this needs to be 700,000.
Mhm.
Then the owners decide to withdraw 100,000 from the company for their own use. So if the owner comes and takes out 100,000, what happens?
So cash will go down and
Cash goes down. Now, when owners take out from the business, that's called drawings, right? And so that's affecting your equity.
Mm-hmm.
Right? When the owners take out, it affects equity. When the owners put in, it affects equity, right?
Yeah.
Because it's an expense.
So equity will also go down?
Yeah. So expenses causes equity to go down. Revenues causes equity to go up.
Yeah.
And a drawing, when they take out money, is an expense. And that's why equity is going to go down by 100,000 as well.
So I got assets is equal to 900,000. Sorry, 900,000 is equal to 300,000 plus 600,000.
Correct. That's what I got too.
Okay.
All right. So now another thing you need to remember how to do is revenue recognition and expense recognition. Okay.
Mm-hmm.
So revenue recognition. So let's say that, let's see if they have any in here that we can do.
The retained earnings, number 13.
No, the retained earnings is different, but we can do this too. Digman Co. had retained earnings of 400,000 on January 1. It made a net income of 300,000 in the year. It paid a dividend of 200,000. The balance of retained earnings at December 31 would be what? So basically, you just have to know your formula for retained earnings. So beginning retained earnings, add net income or deduct a net loss, right? And then you deduct a dividend, if you have a dividend, and then that will give you our retained earnings at the end of the year.
Okay.
So with this, it'll be beginning retained earnings, which is 400,000. Plus your net income, which is 300,000. But if it was a net loss, it will be 400,000 minus 300,000. Okay. And then you deduct your dividend.
Okay.
So 700,000 deduct 200,000 gives you $500,000.
So for the dividend, it doesn't matter if it was paid or not. It still always has to be deducted.
Yeah, once they paid.
Okay.
Yeah. All right, and it'll be paid. Don't worry. I don't know if I see anything on here with revenue recognition, so I'm gonna make one up for you, okay?
Okay.
So let's say that we have KFC Limited sold $5,000 worth of chicken. Right?
Okay.
And the customer paid in cash. How would you record that on your, how would you record that?
Cash. So cash would go down by 5,000.
Again, think again. KFC Limited sold $5,000 worth of chicken and their customer paid in cash. You are KFC, okay? You are KFC. You are not the customer. Okay, always look at yourself as the business. So you are the business. You sold $5,000 worth of chicken and you decided, and the customer paid in cash. So what does the business get?
Revenue.
Revenues, good. And what does revenues affect?
Equity.
Equity. So our equity is gonna go up or down?
Up.
Good. So they're gonna get, the business is getting $5,000 in equity and also $5,000 in the customer paid in cash.
Assets.
Yeah, so your cash is gonna go up 5,000. Perfect. Right?
Right.
Now, the other part of a transaction, that same transaction will say, basically, it costs KFC $3,000 to make the chicken. Okay, so if it costs KFC $3,000 to make the chicken, we now have to recognize, we just recognized revenues, now we have to recognize the
expense.
And the expense is the cost of goods sold, and it causes what? What does the expense affect?
Equity to go down.
Equity goes down by 4,000, and what else happens? Assets goes. What do you think asset is gonna go? If equity goes down,
assets is also gonna go down.
Exactly, because of inventory. We have less chicken now, right?
Yeah.
So inventory goes down, that's the asset. And then the expenses causes the equity to go down. So just then and there, what you've learned to do is you have recognized your revenues, but you've also learned how to recognize an expense. So whenever you're giving a question where you have to recognize revenues, double check and make sure there's nothing there that you need to recognize for your expense as well. Okay?
Yeah. Thank you.
You're welcome. So yeah, I hope this helps. If you have any more questions, feel free to send me an email, okay?
Okay, thank you. I'm gonna go ahead and practice like
All
saying
right.
it out loud.
Just say it out loud, like what I'm doing here, and write
Yeah.
things down. You got this. Don't worry. Good luck. Okay.
Okay.